Welcome to this deep dive into one of the most powerful tools in a trader's arsenal, the MACD, or Moving Average Convergence Divergence. Created by Gerald Appel in the late 1970s, the MACD isn't just a trend-following tool, it's a momentum oscillator. It helps us understand the relationship between two moving averages of a security's price. Whether you are a day trader or a long-term investor, understanding the convergence and divergence of these lines can be the difference between a winning trade and a missed opportunity. Today, we're stripping away the complexity to show you exactly how it works. Before we trade with it, we need to know what we're looking at. The MACD consists of three main components. First, there is the MACD line, usually colored blue. This is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. Next, we have the signal line, often shown in red. This is a 9-period EMA of the MACD line itself. Think of it as the trigger. Finally, there's the histogram. Those bars you see growing and shrinking represent the distance between the MACD line and the signal line. When the bars are above the zero line, momentum is bullish. When they are below, momentum is bearish. The most basic way to use the MACD is by watching for crossovers. A bullish crossover occurs when the MACD line crosses above the signal line. This suggests that momentum is shifting to the upside, often signaling a buy. Conversely, a bearish crossover happens when the MACD line drops below the signal line. This indicates that the bears are taking control, and it might be time to sell or go short. Notice how the histogram disappears at the exact moment of the cross. That's because the gap between the lines is zero. The further the lines spread apart after the cross, the stronger the trend. Now, let's talk about divergence, which is perhaps the MACD's most pro feature. Divergence happens when the price of an asset moves in the opposite direction of the MACD. Bearish divergence occurs when the price makes a higher high, but the MACD makes a lower high. This warns you that the uptrend is losing steam and a reversal might be coming. Bullish divergence is the opposite. The price hits a lower low, but the MACD shows a higher low. This tells us that despite the falling price, selling pressure is drying up. Divergence doesn't always mean an immediate crash or rally, but it's a massive heads up to tighten your stop losses. Another key level is the zero line. When the MACD is above zero, the short-term average is higher than the long-term average, meaning the overall trend is up. Below zero, the trend is down. However, a word of caution. The MACD is a lagging indicator. Because it's based on past price data, it tells you what is happening or has just happened. In choppy or sideways markets, the MACD can give whipsaws, false signals where the lines cross back and forth frequently. This is why we never use the MACD in isolation. To get the best results, pair the MACD with other tools like support and resistance levels or the RSI for confirmation. By mastering the MACD, you aren't just following lines on a screen, you're reading the heartbeat of market momentum. Practice identifying these crossovers and divergences on historical charts before going live. Happy trading!